Many people look at their brokerage statements and ask a simple question. How can a steady stream of cash hitting my account every quarter be a bad thing? Why would anyone turn down regular payouts from massive blue-chip corporations? If you're building a portfolio based entirely on the allure of passive dividend income, we're about to strip away the mainstream hype and look at the raw mathematics. We'll show you why dividend investing can often be a structural illusion and how it triggers a silent financial leak that can quietly drain hundreds of thousands from your future net worth. Reaching true generational freedom isn't about chasing the highest yield on a screen. It's a game of pure asset optimization. Let's dismantle the foundational myth of dividend investing by examining a tale of two individuals, Charlie and Jordan. Both are 32 years old, both earn a clean salary of $95,000 a year, and both are in the same tax bracket. Their baseline income is identical, but their investment philosophies are polar opposites. Charlie is a dedicated cash flow investor. He meticulously constructs a portfolio filled with high-yield dividend stocks and targeted equity funds, capturing an average annual yield of 5.2%. Every quarter, cash allocations hit his ledger, and he automatically reinvests those dividends. He feels a sense of security, convinced he's engineering a flawless wealth machine. Meanwhile, Jordan takes a drastically simpler route. He deploys his capital directly into a low-cost total stock market index fund. He conducts zero corporate research, experiences zero emotional stress, and ignores the news cycle entirely. He simply buys the entire market and steps out of the way. Fast forward 5 years. Charlie's strategy appears to be executing perfectly, generating $4,800 a year in automated cash payouts. He feels like a financial genius. On the flip side, Jordan's account scales to a solid balance of $105,000, yet he hasn't received a single dollar of liquid cash flow. To a casual observer scrolling through social media, Charlie looks like the undisputed hero of this matchup. But we don't play the game on a surface level. Let's dig beneath the marketing layer and run the actual numbers. Before we expose the hidden leak in Charlie's strategy, if you want to stop falling for mainstream consumer traps and start understanding the brutal truths of wealth creation, hit subscribe to Net Plus right now. We don't do generic advice here. We build automated wealth engines. Join the registry, lock in your metrics, and let's get back to the math. To understand why Charlie is actually running at a structural deficit, we must introduce a cornerstone of financial architecture, the Dividend Irrelevance Theory. The retail investing public treats a corporate dividend like a magical cash bonus, but the mathematics tell a different story. A dividend isn't a bonus, it's a forced restructuring of value. Think of a business as a secure vault containing both physical assets and cash. If the market values the company at $120 a share and the board votes to distribute a $4 dividend, that $4 doesn't materialize out of thin air. It's subtracted from the company's internal cash balance. As a result, the intrinsic value drops by that same amount. On the morning of the distribution, the stock opens at $116. You didn't manufacture new wealth. You merely took $4 out of the company's account and moved it into your brokerage account. It's like taking a $20 bill from your right pocket and moving it to your left pocket, thinking you became richer. It isn't real income. It's a forced, automated liquidation of your asset. Here's where the psychological illusion transforms into a silent killer: annual tax drag. This is the friction point that derails millions of investors. When Jordan's index fund grows, the value compounds quietly. Because he doesn't receive cash payouts, he triggers zero taxable events. His capital compounds in peace. Charlie, however, has surrendered control of his tax calendar to a corporate board. Each dividend check that hits his account incurs taxes, even if he reinvests the cash into the same stock. If the payout is a qualified dividend, it faces a tax rate of about 15%.
Non-qualified dividends can be taxed at rates as high as 37%. At first glance, an amateur might shrug off this annual tax bill. After all, it's just a few $100s, right? This is a catastrophic miscalculation of compounding velocity. Over a 30-year career, a continuous leak of even 1% due to tax drag acts as a severe brake on wealth. You're not just losing money to the government, you're losing the compounding power those tax dollars would have generated over decades. This isn't a minor issue. It can easily scale into a $450,000 penalty over a lifetime. The flaws of a dividend-centric strategy extend beyond taxes. They introduce severe portfolio concentration risk. Many dividend-focused investors fall into yield traps. They chase companies offering astronomical yields of 8%, 10%, or 12%, ignoring why the yield is so high. A company's dividend yield is a moving ratio, the annual payout divided by the stock price. If a business is in decline, its stock price crashes while the dividend payout remains the same on paper, creating a misleading yield. Historic giants like General Electric and Macy's have cut or eliminated dividends when reality caught up. When a dividend is cut, income investors panic, leading to a catastrophic collapse. You face a brutal double whammy. Your cash flow disappears and your principal capital is decimated. Additionally, a portfolio focused on high payouts restricts capital from the primary drivers of economic growth. Companies paying large dividends often do so because they lack innovative opportunities. Utilities or legacy manufacturers can't easily double their infrastructure or invent disruptive technologies. They return profits to shareholders. In contrast, hyper-growth engines like semiconductor designers and AI pioneers rarely pay dividends. They reinvest profits into research and development. Over the past 2 decades, these tech titans have driven most market returns.
By limiting your allocations to high-yield stocks, you lock yourself out of the fastest wealth-building vehicles. Let's fast forward 30 years to see how these structural variables play out. Charlie and Jordan are now 62 years old, ready for retirement. Let's check the scoreboard. Jordan's index fund has grown to $2.6 million. Charlie's dividend-heavy portfolio, burdened by taxes and lack of growth exposure, finishes at $1.950 million. The gap? A staggering $650,000 left on the table. Charlie never realized he was losing because his statements always showed positive numbers, and those quarterly deposits provided a false sense of victory. Over 30 years, Charlie paid tens of thousands in federal taxes, while Jordan paid next to nothing. That wealth gap didn't disappear. It was systematically transferred to the IRS, while Jordan's capital remained deployed and compounding. At this point, a die-hard dividend advocate might argue, but Charlie can live off his cash payouts without selling shares, while Jordan has to sell his index fund. Let's dismantle that argument with standard retirement math. Assuming both need $65,000 a year, Charlie's portfolio generates $75,000 in dividends, but after taxes, he nets $65,000. Jordan logs in and sells $65,000 worth of his index fund shares. Here's the monumental difference. Jordan has total control over his tax liability. Under current tax rules, long-term capital gains can be taxed at 0% for certain income thresholds. By executing a disciplined withdrawal strategy, Jordan keeps his tax bill near zero. The result? Both enjoy the same retirement lifestyle, but Jordan has a capital reserve that's $650,000 larger, diversified, and still growing. He didn't let a corporate board dictate his tax strategy during accumulation or retirement. This doesn't mean dividend stocks are evil. High-quality businesses generating consistent cash flow are fantastic assets. If you love receiving regular dividends, keep those assets in tax-advantaged accounts like a Roth IRA. Inside this shield, dividends can compound for decades without tax drag. But if you're in a taxable brokerage account during your wealth accumulation years, chasing dividends is a drag on your financial velocity. A total market index fund will always outperform. It offers lower fees, superior diversification, zero tax leaks, and complete control over gains. Stop measuring success by the cash flow a corporate board decides to hand back. Shift your focus to total return, the actual growth of your net worth. This is Net Plus, where finance is no longer a mystery, but a language you speak fluently. Protect your capital baseline and let time run your wealth engine. Choose total return over marketing illusions. Clear the path. Let's begin.